Hi, I'm Jordan Wilson. Today we'll finish up our look at asset allocation considerations by looking at the equity asset class. We'll start off doing a quick recap on equities. We'll look at some of the asset allocation considerations by life cycle phase, as well as some focal points and how personal circumstances play a role in what your target asset allocation should be. So equities, we talked about equities already. I'm going to call them just common shares. We'll exclude preferred, and that's because preferred shares, they act more as a fixed income vehicle in how they operate. And I tend to include them as part of fixed income and not equities. So if we look at common shares, of the three asset classes, cash, fixed income, equities, common shares will have the highest risk, but also the highest expected return. Within the asset class, though, there's going to be a wide variance of risk and return. We also see that depending on your investment objectives, investors may target equities that tend to generate dividend streams. For example, value stocks. Others may have no concern about dividends and want all their income in capital gains when they sell the asset. That would probably be more of a growth stock investor. Within equities, there's probably more international exposure for investors than with cash or fixed income. That's not to say that you cannot get foreign exchange exposure in cash or fixed income. It's just probably more options as far as equities go and more interest. And when we're talking both the variance in risk and return or international, a quick example would be, say, the developed nations, United States, Canada, what's called EAFE, Europe, Australasia, the Far East. The developed nations would be less risky than an emerging market or a frontier market. And an emerging market example would be, let's say, Colombia, Mexico, Poland. Unfortunately, within the emerging markets, you also have what they call the BRICS: Brazil, Russia, India, China. And those obviously have huge economies, and that kind of distorts what emerging markets are. And so many mutual funds will either create a BRIC exclusive ETF or mutual fund, or in their emerging markets, they may exclude those huge countries. So just know that if they're in or they're out in the emerging markets that you're looking at for investments. On the very small end, you have what they call the frontier market. And that could be Morocco, Kenya, Romania. So even smaller or less developed as far as capital markets go than the emerging markets. And obviously, as you go down and get less and less of capital market exposure, you might have less transparency. You might have less liquidity. And as a result, those will be riskier on average, and they will require investors to receive higher returns. And over time, I think you've seen that emerging markets have done quite well as an asset class, or a subclass in this case. So equities, they're useful for people with longer term time horizons. people that don't require immediate liquidity, because relative to cash or fixed income, equities are probably less liquid. And because of the higher risk, they're useful for people with more aggressive risk tolerances. Accumulators, just a reminder, on average, relatively young, starting out in their careers, little capital, little disposable income, little free cash. They're looking for liquidity. Short-term obligations and objectives tend to be key. And from a pure investing phase, they're looking probably at longer time horizons. As such, if they do have free cash, equities are very well suited for accumulators. Asset allocation. I see here about 80 to 90% in equities, but that ignores the emergency cash reserves that we talked about. And because accumulators have very little wealth, and we're suggesting maybe 3 to 6 months of cash in emergency reserves, that may just put the whole thing out of alignment. It might be 100% in cash or 90% in cash. So we'll just ignore the emergency reserve here, and we'll assume that 80 to 90% is based on having only 10% in cash and then 10% in fixed income for diversification. You could go 100%, that's fine, but again, diversification benefits of fixed income might be worth having a little bit in the portfolio, sacrifice potential return to protect you in case the equity markets fall. Because we talked previously that currently fixed income has, roughly a 0.35-ish negative correlation with equities, which means that if equities rise, fixed income suffers, but if equities fall, having a little bit of fixed income on hand will provide a little bit of a buffer. Focal points, liquidity may be an issue, less of an issue if you're invested in blue chip stocks like Coca-Cola, large companies that trade on major exchanges, Google, Amazon, Apple. Even in a down market, you can jump in and out, as opposed to what we're seeing in this last week, GameStop, small companies that if there's a short positions taken, or in this case, the short squeeze, there might be liquidity issues for investors. I mentioned how emergency reserves can create an allocation issue. So that's just something to keep in mind, that I often just sort of say, let's back the emergency reserves out of our portfolio mix. And then we're looking at pure investing as opposed to juggling our emergency funds. And we just talked about value versus growth. Do I want dividends or do I want capital gains? Do I want to invest in Romania or Poland, the frontier or the emergent markets? Or do I just want to invest in large cap developed nation stocks? So you have to look at how you want to allocate within the asset class, and some are going to be less risky and some will be more risky. So even if you're in 80% equities, you can greatly change the risk return profile within this asset class just by how you allocate in the subclasses. Consolidators, middle of careers, incomes relatively high, expenses manageable. They do have some wealth accumulated, debts, not maybe all paid off, but the house is paid down, probably no car loans anymore. This is the serious investing phase. And we're talking here probably 65 to 85% in equities. And that assumes 5% allocated to cash and 10 to 30% for fixed income. That percentage of allocation may be less if they're diversifying via other asset classes, maybe real estate, maybe commodities, There's a variety of other investment classes that you can buy. The question is, do you need them? And we'll look at that in a separate episode. My focal points here, again, we talked about this diversification within the equities themselves. The frontier, higher risk, less liquidity, versus emerging markets versus developed nations, value versus growth. Home country bias, that's another issue that we'll look into separately. In your home country, if you're the United States, then as an investor, the US makes up about 45, 48% of the world's global capital markets. So if you have a home country bias, that means you're probably 60 or 70% invested in the US. For a Canadian, this is a huge problem because Canadian stocks make up about 4% of the global equity markets. Yet if you look at your own portfolio, or you look at many mutual funds, you'll see that you probably have 20 or 30, maybe even 40% invested in Canadian equities. That's a home country bias. Maybe you want it, and there's legitimate reasons to do so. But I think on average, there's probably better reasons to not have a home country bias. Similarly, foreign exchange exposure or hedging. Again, there's pros and cons to both routes. But basically that's just, if I'm a Canadian and I'm buying a European fund, do I want exposure to the euro? Or Japan, do I want exposure to the yen? Or do I want my portfolio hedged against the Canadian dollar? And then do we want to add other asset classes? Pros and cons to that. They do provide, in many cases, additional diversification benefits. Often, some of the less liquid especially offer higher potential expected returns. But do you need it? That's questionable. And we'll look at that later to see, okay, everyone tells me I need real estate in my portfolio, and all you're telling me is cash, fixed income, and equities. Where's my real estate? Maybe, but again, when we get into that section or that episode, we'll see that just by buying a bog standard Canadian or American or global equity fund, you probably end up with a nice piece of real estate exposure through the REITs and the other businesses that are made up on the indices. So we'll talk about that a little bit later, but that's a consideration. Finally, the spenders at, near retirement, want to enjoy life. They still potentially have a long time horizon to live, but they don't have, in all likelihood, employment income, so they're living off pension savings. Hopefully they have a high level of accumulated wealth. Their cost base might be lower because they're no longer working, but at the same time, there could be health issues. Maybe they want to travel or have other leisure activities now they're retired. So costs can sneak up on you if you want to enjoy life. Because of the long time horizon, retiring at 65, life expectancy, mid-80s, early 90s, still a long time. So you don't want to go that 80 to 90% fixed income like many people do. In fact, you probably want to still consider being over 50% in equities. And I've got a target here, 50 to 65% equities, assuming 5 to 10% cash, 30 to 40% fixed income. And then as the age increases, you would shift slowly year by year into more safe, secure, lower risk, less return assets like fixed income. Things you have to consider: based on my family history, my lifestyle, what's my time horizon? What type of equities do I want? Do I want value stocks that are going to generate income in dividends for me? Do I want blue chip stocks that might provide some dividends, some growth, but they're going to be quite liquid? And if I need the cash, I probably won't see too much price changing. You could also buy low volatility stocks or low volatility funds, which are equity funds that are specifically chosen for minimum or reduced volatility. And volatility is the standard deviation, the risk. And what you would expect from that is sacrificing a little bit of return for the less risk, but then there's going to be smaller price swings. You also have to look at your retirement lifestyle. Am I retiring in the Cayman Islands, where rents are high and going out to dinner is very expensive? Or am I going to live in Western Canada, where it might be relatively less expensive to live? So that's going to play a part into how fast your savings go and the need, therefore, to maintain higher risk, higher return instruments to compensate for I won't say extravagant, but on a relative basis, a more extravagant lifestyle. So that's our look at asset allocation considerations for cash, fixed income, and equities. I think you can see there's a lot of variability in what you might want to allocate to each asset class. Depends on the phase of your life, depends on your risk tolerance, depends on your objectives and constraints. Essentially everything we looked at in the investor profile, which is why the investor profile should be driving your target asset allocation. And I think from that, you'll also see quite readily that you are unique to some degree. Your needs, your objectives, your risk tolerance are probably different from your coworkers or other family members. So you need to sit down and assess your own target asset allocation that works best for you. And you can't just say, like the old standard was, subtract your age from 100 and that's the allocation to equities. It's a lot more complex, or it should be a lot more complex than that. And even when you get into the individual asset classes, you've got a lot of choices to make and a lot of options. More risk, less risk, foreign currency, hedging, non-hedging, home country biases. So lots of considerations that will ultimately create a target asset allocation by class and subclass, and then in the individual assets that differs from everyone else's. So think about those things as you look at what you want to do. And I think an easy way to invest for most retail investors, so mass affluent, let's say, people under $2 million, is using mutual funds or exchange traded funds to deal with some of these issues that we just talked about, and we'll flesh that out going forward. So thanks for the time, and have yourself a good day.